Welcome in, folks. It's a buy one, get one free here today. First one up here, we're going to react to Mike Wilson. Mike Wilson's been arguably the biggest bear on the market the last couple of years. So we're going to go ahead and react to him and his views on the market, stock picking opportunities and things like that. So looking forward to getting into that one. And then we're going to go ahead and get into this one. Catalysts and concerns for Amazon and Meta. Speaking about those stocks, I will be going live right after this video is released. Pin comment down there to join me for that. Meta, Amazon, Apple, earnings all after the bell. Ooh, boy, it's going to be huge. We're also going to listen to the Meta conference call on there, and we might also listen to Amazon conference call as well after the bell. So that's going to be massive, man. Pin comment down there to join me. That should be a record breaker. Let's get into this.
Look, was a theme in a recent note of yours. How convictionless are things right now?
Well, look, we spend time with clients all the time. That's what we do for a living. And I would just say that, we had this big rally after, the pivot. And I would say it started with the Treasury squeeze when they said they're going to issue less coupons. So it was really a duration rally that then fed into a stock rally. And so now valuations are stretched again, and people are looking around going, okay, what's next? What's the next catalyst? I think there's going to be a couple things that will determine the direction. Number one, how much deceleration do we get? Okay, we'll come back to this banking question. I think that's, to me, that issue is not a systemic issue. What it is a weight on growth, on credit growth. Okay, like the regional banking system is just not lending at the same rate that they were because they're constrained, and that's been our view all along. Which means quality stocks will continue to do better. Right, the companies that are reliant on that kind of funding are going to continue to see that's a paperweight for them. And I think that's the main takeaway from the banking situation. And then, of course, new themes will evolve. Last year was about two main themes, right? It was about GLPs and AI. So can those two themes continue to drive the stock market? Yeah, to some degree, but it's probably going to morph a bit, and then there'll be new themes. And I think that's what investors are looking for now, looking for new themes to kind of latch onto in a world that's going to remain macro uncertain, is the way I would say.
Can you identify any themes right now?
Well, I think the AI theme is the one, instead of enablers, we're going to adopters, right? So that's probably the biggest theme we have as a firm. The GLP one is sort of positive and negative, as we've seen, and that's a great thing for long-short investors. And then I'm wondering if we're going to get some growth out of the international markets finally. International economies have not really recovered from the pandemic yet, for the most part, and I think that's a wild card. So if that were to happen, that could be a great theme for EM. It could be a theme for things that are levered more to global growth as opposed to just the U.S., which has really been the only engine of growth.
Since you say that you fly around and you talk with clients, I was just noticing some of your recent travels. You were recently in Miami.
Yes.
I imagine you're getting a lot of points, by the way. You talked about the AI stock, saying, I think it's the Magnificent Four now, and it's related to earnings. Who are the Magnificent Four? Who gets dropped?
Yeah, well, I think it's, we're not talking about specific names, but I think it's obvious. People have been talking about this too. I'm not the only one, right? We're seeing, you can identify which stocks have fallen off. But what we look at is earnings, okay? And I would say there's a Magnificent One, quite frankly, that has real top-line acceleration growth. Everybody knows what it is. And then the other ones are been more cost-cutting stories.
It rides with NVIDIA?
Yeah, and my sense is that what we're going to see here is a broadening out in quality growth. So in other words, when we do our screens on quality growth, only 27% of that basket is in IT. Another 10 or 12% is in comm services. So that leaves another 60 to 70% of the S&P 500 that kind of qualify for that high quality growth.
So let me push back against Mike Wilson right here. So he tries to claim that NVIDIA is really the only story of revenue growth, and the other stories are just of, we can call it like cost cutting, okay? Listen, it's baloney. Here's the fact, okay? Meta's growth has obviously massively reaccelerated. The guidance was very strong that they gave last quarter. We'll see what the numbers are after the bell here. Same thing with Amazon. It's a reacceleration of growth story. Even Google is a reacceleration of growth story. So if we look at, many of those Magnificent Seven, it's not just cost cutting. It's really reacceleration of growth stories for almost all those stocks. Apple, we haven't seen it yet. Microsoft has been putting up incredible numbers. Their numbers on Tuesday were phenomenal. So yeah, it's not like NVIDIA is the only one that has a growth story behind it.
Bucket. And that's what should happen. We should broaden out if we have a soft landing that doesn't have other issues. And that's the other thing that we've been really trying to help clients with, is give them a framework on the macro. That's what we do. And say, here are the three buckets, okay? Soft landing with decelerating growth and decelerating inflation. That's kind of what we had last year. It's high quality growth. A soft landing with accelerating growth and maybe stickier inflation. And that's an environment where you could see a broadening out, perhaps to lower quality areas. And then the third scenario is still a hard landing. I mean, we can't eliminate that. And I think that's going to be how, that's going to determine how you position your portfolio from a stock standpoint.
How do you hedge if you are cautious and there is this uncertainty? Is it energy stocks? Is it more duration sensitive stocks? I mean, how do you even understand what it means to hedge when you have such bipolar types of outcomes?
It's diversification. You got to be diversified. Now, one of the things we talked about at this conference as well, which didn't make the headlines, is this idea that we finally have very attractive real rates and nominal rates to some degree. So from a portfolio construction standpoint, okay, this is the first time in 15 years where you can bonds actually provide their diversification benefit. And we saw that yesterday, right? Bonds rallied, stocks were down. So, we're very bullish we've been bullish on duration since 490 on a 10-year. I mean, so here we are, whatever, it's probably not as good a value, but in the event that something systemic does happen, there's another shock to the economy, that bond portfolio now the yields are high enough where they can actually provide some diversification to your equity risk, which means you can take equity risk, still up the quality curve, okay? So it's a diversification between stocks and bonds, and then understanding what within the equity market you feel more comfortable with. If things get better on the economic front and we see better growth, then we can go out the risk curve in equities. We can take more equity risk as long as we have that duration benefit on the bond side.
You mentioned that change in theme from AI.
Yeah, in my opinion on hedging, I think right now it's a very easy time to hedge your portfolio, to hedge in general, and to diversify in general. And why do I say that? One is interest rates. I mean, treasuries yield still 5% plus. You got savings accounts yielding 4.5%. I think right there, cash can be a hedge in itself, especially if that cash is able to generate 4 to 5%. That's good. Next up is there's plenty of overvalued stocks in this market right now. There's several of them out there I can think of off the top of my head. So I think that's an easy way to hedge, right? You could also hedge against large cap if you want. Large cap valuations have been pushed immensely. So if you get a big pullback in the market, the large guys are going to get hit. The stocks that are very overvalued and trading at insane forward P ratios, those stocks are going to get, hit massively. And you got cash generating you 4 to 5%. So I think it's one of the most easy times to hedge your portfolio that I've seen, certainly in my investing lifetime, which dates back to 2008, 2009.
People as to adopters. Where should I be looking for adopters? What does that mean? What does that look like?
Well, it looks more non-tech, right? So who are going to be the early adopters within, the adoption of tech, AI as a cost, benefit, as well as driving new growth. Now, we've written about this already. We think it's more of a 25 story.
Okay.
Like the productivity story is really 25. So we're not that bullish on earnings this year relative to the street. Street's at like 244 bottoms up. We're 230. That's the typical pattern. It will probably come down to our 230. But then for next year, we have 266. That's 16% growth. And a lot of that's going to be driven by productivity improvements as this is adopted. I don't think this is a second quarter, first, second, third quarter, even fourth quarter. It's going to take a little bit of time. But our analysts, we wrote a report recently, bottoms up report, identifying the potential winners in that. And the market will probably start to sniff that out sometime during the year. They're not going to wait all the way until 2025. But that runs the gamut of industries away from tech.
Are they labor intensive industries?
It can be. It can be labor intensive, but it can also be growth drivers. I mean, like if you use AI to, as an effective way of marketing, like as a cheaper way of marketing to get new customers. I mean, we don't know yet. This is what's exciting about it. It's also uncertain. There's also going to be a lot of losers. Okay. Now, one of the things that worries me a little bit about AI in the short term, we've seen a lot of layoffs recently within the tech sector. So, maybe these guys are already seeing the benefits and they're able to remove headcount. So, the labor market, I think there's various views on the labor market. I mean, our view is it's slowing, it's weakening. A lot of government jobs, a lot of healthcare, social worker type jobs, which are somewhat government related. And if companies get efficient, this could be an interesting catalyst actually for more layoffs potentially. So it's going to be uncertain, right?
Okay, I just have to ask this because I get messages all the time. You're such a downer. Why are you so pessimistic? When you go around and you're talking to...
Okay, before we go further here and he answers that, let me say this about Mike Wilson. I'm reading his tonality, I'm seeing the way he's talking here, listening to his points, okay? Let me say this. I think he's getting a little less bearish. based upon what I'm hearing out of this man, his tonality, everything like that, I would read this as he's starting to get less bearish, which scares me because when we lose the last bears, that means we're really screwed. Okay, so but that's kind of the way I'm reading Mike Wilson here. Still, a little concerned, but I don't think. I mean, if you listen to Mike Wilson a year and a half ago, I think he was, his tonality was a lot different.
Different clients. How much pushback do you get to just sort of a more realistic view of the potential risks, given that only the rosiest seem to have come to pass?
Well, look, I mean, our clients are active managers, right? So they're not worried about the S&P 500. They're trying to find what works. I mean, for all of the headlines we get around the S&P 500, I mean, what we usually talk to clients about are individual sectors and stocks and like what's going to work. And so like last year we get an F on S&P, but we get probably an A or B on being in the right places in the market. And that's our job. And that's what active managers are trying to do. So, you don't have to be super bearish, it's not about being bullish or bearish. It's about being bullish in certain parts of the market and opportunity and being cautious or concerned about others. And look, last year was a really great stock picking market. That most stocks, up until October 27th had a tough time. And then we had this little rally at the end of the year. And we've been very consistent about this over the last 12 to 18 months, as you guys know. I mean, we don't think the trade is to then, go to the lower quality bucket, okay? To go for the low quality cyclicals. And like, that's a recession trade. We're not in a recession. You need a clearing event. That was our call in 2020. Then that worked really, really well. Don't overthink it, right? You need to buy the high quality growth stocks, and it's not all Mag 7, all right? There are other businesses that have those characteristics who are maybe not as appreciated.
So, nice way to try to spin it there, Mike Wilson. I appreciate that attempt to spin there, but at the end of the day, you guys were ridiculously bearish on the S&P 500 last year. You stayed very, very bearish, and it's just been wrong, right? All right, so looking forward to getting in this one. Meta, Amazon, all these stocks here. I just want to see if I got anything to finish out Mike Wilson. I think I'll let that be for now. Let's go ahead and jump into this one.
Up 17.5% since November 1st. What matters here? AWS growth. We're going to get the holiday quarter, obviously, for Marketplace. AI, generative AI is going to be a big play here. How do we think about this here?
80 cents in earnings per share. A year ago, they did 3 cents. What I said at the open is really the story. All this leaning out and efficiency, they pulled back the reins on trying to deliver things. Like they were at 1 day and then it was like 6 hours. Do you go to an hour, or can people relax and we can have some margin expansion? Reintroducing ads into the television product. That'll be interesting. We'll get some color on that. But that quarterly operating income number projected to grow 280% to $10 billion. We don't really think of Amazon in terms of this juggernaut throwing off, that kind of free cash flow, et cetera. We always have historically thought of it as a company that's really good at growing vertically and horizontally and just constantly.
Before we go further here, you guys know, if you've been watching my videos religiously, there's one stock that I felt very confident is going to have a blowout earnings and just knock the doors off. And that stock is Amazon. We'll see shortly whether that comes to fruition and that's true or not. But that's the one stock that of big tech I felt like they're kind of just wow everybody. So we'll see. Maybe I'm wrong on that and they barely beat, or they missed numbers, something like that. But that's the one stock that I'm like, I think they're gonna just knock the doors off.
Delivering on growth, and they are doing that, by the way. AWS is going to be a 13% year-over-year number. It's not 20, but it's also not 2% like Apple. So you're going to get the growth in the AWS business to about $24 billion. That'll be important. But again, thinking about Amazon in terms of its streamlining and in terms of it becoming more profitable, I think makes it a more interesting story for this year. And I agree with what Bryn had to say. If you ask me, which of these names has a better chance of outperforming, I think Amazon versus Apple. I own both. That's what I think is going to happen now.
Sarat, how do you
I'm on your camp.
this?
Yeah, I'm in your camp. I think Amazon's future for the next few quarters is a lot better than when you compare it to Apple, because they've got the levers to pull. I really like the Prime example, where you start now, put advertising in there. That's margin that drops to the bottom line.
Yeah.
Right? And you start putting, I mean, their efficiency in terms of logistics, that's all going to start to get optimized as well. So you will see that, and that's what investors want, the cash flow and efficiency.
Two things really quickly on the ads. Number one, in 3 years, Amazon became the third largest advertising platform in the world. Like, we're not giving this company any credit for that, but that's a true statement. That's an actual fact. Number two, if you listen to what Netflix had to say the other day, actually, the subscribers that are on the ad tier are more profitable than the subscribers paying full price on the premium tier. Also, not something that I think anyone expected from Netflix or from Prime, for that matter, as they push into this. And then the third thing, and of course, we don't know yet, but very important to point out, any news that they have to share on their AI efforts is going to get a lot of attention just because of the built-in user base that Amazon has to power with AI applications. They have not been the most vocal, but Anthropic is a big deal, and they could talk a lot about that tonight, which I think would be additional upside.
So you guys kind of alluded to this, but let's go deeper.
To go a little deeper here in Amazon, kind of what I'm expecting really strong e-commerce numbers. In terms of AWS, I am expecting beats there, and I'm expecting a pretty strong guidance in terms of re-acceleration and growth. The ads business, I'm expecting that to continue to be booming. And so those are the three main businesses, obviously, at Amazon. And so I'm expecting all to be really good. And that's why I feel pretty confident about them coming in and knocking the doors off in terms of their numbers, because I expect all three business lines to be in a much better place than they've been. Let's just call it over the past year or so. So we'll see where all this shakes out. And then if they have any guidance to give, that's going to be really exciting as well.
On Bryn, whether you think this is the week that these mega cap stocks separate themselves from each other, that they don't trade anymore as a virtual group.
To be fair, in all due respect, listen, they've already been doing that. Look at the returns last year for Meta stock versus Apple stock versus Microsoft stock versus Nvidia stock versus Amazon stock. I'll be honest with you guys. I mean, look at the returns. It wasn't like they all had roughly the same return. No, they're dramatically different. Dramatically different. Some of those stocks might have been up 30, 40, 50%. Some of the stocks were up 100, 200 plus percent, right? And so I think there's already been a divergence happening between these magnificent seven, as they call them, right? And I think there's going to continue to be a divergence between, the ones that, are having some trouble, which let's just call it what it is. It's Apple and it's Tesla, right? Those are the ones that have been struggling here in the short term. And then the ones that are doing really well, like the Nvidias and the Metas, those are in a different category, right?
We do get the, divergence between some of these names. Now, maybe the seeds of that have been sown with Microsoft and Alphabet, but you tell me what you think.
I think directionally, they can move in the same direction. I think the magnitude, though, will be very different. And so if you think about Amazon also, one thing that Surat and Josh didn't mention is if you've ever toured an Amazon warehouse, they are incredibly sophisticated robotics, but they also have a lot of people doing very tedious tasks. And I think that Amazon, more than any of the mega caps, internally is going to continue to benefit from the productivity increase that their robotics are able to replace humans, and that will go straight to the bottom line. And so I think between their partnership with Anthropic, I think that Amazon is actually flat over the last 2 years. And so we all like to talk about 1 year returns, but really over the last 2 years, it's been dead money. I think Andy Jassy has his sea legs. So I think there's all of these little metrics where Amazon, along with Microsoft, can really start pulling away and have, once again, a much more magnitude of a return than I think in Apple, which will be a laggard.
Yeah, my prediction is Amazon, new all-time highs incoming. We'll see. I could be wrong. And maybe they come in, report crap numbers, stock tanks 10, 15%. I don't know. I don't think that's super realistic in my opinion. I think new all-time highs. We'll see. And we'll see very shortly, folks. And if you want to join me live for it, pin comment down there. Twitch should be a record-breaking live stream, folks. I'm about to go live on there right now. Okay, pin comment. Much love and have a great day.